Most traders lose money trading ranges because the market often breaks one side of the range, traps traders, and then continues in its original trend direction. In this video I'll show you a simple range trading setup that makes trading ranges much easier. A range forms when price moves sideways without a clear trend. During these conditions, many traders make the mistake of chasing the first breakout. Instead, here's what you should do. Step 1. Identify the trend on the higher time frame, for example the 1-hour chart. As you can see, price is in an uptrend. Step 2. Once price starts ranging in the lower time frames, find an unmitigated order block or fair value gap that formed before the range, in the direction of the trend. Step 3. Wait for price to break one side of the range and tap into that order block or fair value gap. Don't enter immediately. Wait for a clear rejection, such as a strong wick or a rejection candle. Then, you can plan a trade and the target will be the other side liquidity. These are the rules for this setup. I recommend taking a screenshot or writing them down, because following these rules consistently is just as important as the setup itself. This setup works best on gold, US 30, and Nasdaq 100 due to their high liquidity. Let's look at a trade example. This setup was taken on Nasdaq 100 on June 30, 2026. As you can see, price is bullish on the 15-minute time frame. After the uptrend, price starts moving sideways, forming a range. Next, we identify the unmitigated order block and fair value gap that formed before the range. When price sweeps the downside liquidity and taps into our area of interest, we shift to a lower time frame, such as the 3-minute chart, and wait for a clear rejection. Once we get that confirmation, we can enter the trade. The first target can be the recent high, or if the trend remains strong, you can trail your stop loss and let the trade continue. Let's look at another example. This trade was taken on gold, on July 9, 2026. On the 1-hour chart, we can clearly see that price is in a downtrend. When we switch to the 15-minute chart, price begins to form a range. Since the higher time frame trend is bearish, we'll only look for selling opportunities. We identify the unmitigated order block and fair value gap that align with the trend. Once price sweeps the range, taps into our area of interest, and gives a clear rejection on the lower time frame, we can enter the trade, targeting the next swing low or trailing the position if the downtrend continues. This strategy is simple, but executing it in the live market requires patience and discipline. Remember, no strategy alone can make you profitable. Consistent execution and proper risk management are what make the difference. If you have any questions, leave them in the comments below. Thanks for watching, and I'll see you in the next one.